Okay, very groovy. Here we are again. I'm Guillaume Lambert. I'm joined with Nathan Burks here from the Panoptic Research Team. This is Beyond the Greeks, research insights from the Panoptic Research Team. Yeah, how are you doing today, Nathan?
All right. How about you?
Good. Yeah, very busy few weeks. We had ETC at Con, and then we had the community retreat. Barely
Yes.
feels like I'm back above water, but research is very important. I'm happy to do the live stream with you today. Um, yeah, interesting few. Again, one thing I want to touch upon as well is the Open team got acquired. The leadership team at Open got acquired by Coinbase. Uh, I love the Open team. They were very the innovative, creating products. They were able to kind of push this quite forward. They were unjustly targeted by CFTC. Now I'm happy that
Yes.
they see a second life. Well, yeah, what are your thoughts on this, Nathan?
I can only speak for myself, but I mean, just as long as I've been in this space, I've had a ton of respect for both Andrew Leone or Leone, depending on how you pronounce, and Joe Clark. Joe Clark, in particular, I think just through his research taught me a lot on how I've always considered them fellow travelers to Panoptic in the sense, and in Joe Clark's research, you find this specifically of how LP payoffs and LP shares are extremely malleable and can be transformed. And I've also considered them like at the forefront of this space from the standpoint of what you just said, fighting the regulatory regime, at least the prior one. So if they can transpose what they've managed to do with Open at Coinbase, I think it's great. I think it's
Exactly.
great for the space.
It's That's right. They probably have I don't know 1,000 times the resource and users, and kind of the ceiling is much higher for that team. I'm very happy. Again, Coinbase is crushing it with acquiring Deribit, offering perps on their platforms. Now with kind of getting the open team, great signaling for
Yes,
derivatives and the option space.
I think that's a great pairing because Andrew, if I recall his background correctly, was a VIX options market maker at one point. So
Hmm.
having his brain alongside the acquisition of Deribit, I think, well, and Joe Clark's academic bona fides, I think will really help in pushing the option space forward.
All right, you're making me too bullish, Nathan. This is great. I didn't know he was a VIX options trader.
I'm pretty sure
Yeah,
he was in a previous life.
exactly. This is fantastic. So, yeah, I mean, the value prop of Panoptic and options more generally is that there's a lot of use cases. It's a complex product, but it's a rich product. There's a lot of strategies you can implement. There's a lot of little corners to go through, but overall, you can study this for years and years, and you won't even scratch the surface. This is part of our goal now is to do that bit of research, make it public, make it palatable for you guys.
Mm.
And yeah, Nathan has a very interesting piece for us to mind setting up, and then we can go with the sharing your slides.
It's on the variance risk premium and synthetic perps. Synthetic perps being synthetic perp futures that you originate through options, and that's done by longing at least a long perp is through longing in a 50 delta call and shorting a 50 delta put. So it simulates the payoff of a perpetual future. And the variance risk premium is interesting because you get to see it's the realized component that's interesting. So it's realized variance minus implied variance, and that is absorbed through per futures most of the time, the realized component. So we've
Amazing.
managed to replicate it through options.
Amazing. So again, this is a again. Oh, all right. So I'll have you. You always start in a good place. This is in this case oil. All right. I'll let you take it
Yes.
away.
Just like with this title slide, what I wanted to touch upon quickly was the fact that, like in, say, in the oil market, the crude market, um, with either what you see in futures term structure is either contango or backwardation. So with contango, an upward sloping futures term slope or term structure; with backwardation, a downward sloping futures term structure. And where this ties into options is that in either case, um, either a severe contango or severe backwardation, you see elevated vol as a result of that. And that's kind of what this chart shows. In the case of empty storage, you have severe backwardation; filled storage, severe contango. And in both cases, you see local peaks in vol associated with each of them. So that's what I'm going to be going into today, is how this manifests itself um, with synthetic perps, and specifically disaggregating it further in positive vol, like upside vol or
So
downside.
wait, so this is real data, but then is it really a whatever 10% change in production yields to the IV going from 25 to like 70 or 50?
Well, this is realized vol
I see.
specific in this chart, so
No,
not implied vol.
but I
Oh,
feel
go ahead.
like the it's quite steep. You have 25% maybe at the peak, I guess. As you empty the field, you have 50%, which is twice as high. It pretty tells you that the whole world is optimized towards that whatever $2.05 billion barrels of oil. Anything above or below that is extremely dangerous and risky, I guess.
Yeah, I'm not sure. I can't remember offhand the sample period for this, but just to like harken back to implied vol at one of these extremes, um, the example I'm about to use in the case of filled storage, think back to April 2020 when we had the super contango and oil price went negative. Um, Vol shot through the roof. So I wouldn't say this is totally unprecedented, that
Maybe.
level of shifting.
I know. All right.
Um, but just to give an idea of like the prism I'm going to cast this under, like the with the variance risk premium, it's predicated on, as I mentioned, realized variance minus implied variance. The graphic you see on the left is the variance risk premium over a certain sample range for natural gas, and you see how variable it is. Um, and I think this is very much akin to BTC and ETH. Uh, and a way I like to quantify realized variances through the lens of volatility clustering, which is captured on the right, with just BMW daily returns. And as you can see, like large, and what volatility clustering essentially is, it's large changes forecast or portending large changes, and small changes portending small changes. And the clustering effect is stronger with large changes as opposed to small changes. So I'll expand on that in a few minutes, how that ties in. But as I already mentioned, contango and backwardation, if there are extremes in either one, they tend to cause spikes in vol. Uh, as you can see with the graphic on the left, the highest spike in vol coincides with a large contango, but there are local peaks with backwardation as well. And those are for index futures. So it doesn't necessarily have to be for commodities, because they really are indicative of underlying market states. Um, and then with the graphic on the right, specifically, um, like with BTC contango, a lot of what it portends, like it's an uptrending underlying, but it's also reflective of impending crash risk. So you go up the stairs, down the elevator really quickly, and that's how. And I'm once again, I'm going to tie all this together, but it is interesting how it's this slow. It's up the Matterhorn, and then all of a sudden down the slope all the way. So this is how this dynamic is reflected within crypto specifically. So these are ETH and BTC synthetic long perp returns. Um, Definitely you see more gains on the long. If you wanted to flip this graph, you'd have the short perp returns. Uh, Specifically, there's more upside when going long as opposed to going short. In both cases, they diverge a little bit on when you see peaks in the long returns versus the short returns, just based on different characteristics between either pool. These were conducted with the ETH and BTC 30 bips pools, but where it gets interesting is looking at the implied and realized variance patterns of either one of these assets. So with ETH, you have the rolling 30-day variance risk premium, the rolling spot RV or realized volatility correlation. And on the right hand side, you have the persistence of the up vol and the down vol. And by up vol and down vol, I mean the volatility realized over a certain span with returns above zero, so positive returns, and then the volatility realized over negative returns. And what you find is that the variance risk premium tends to peak or be positive when there's increased um, up vol clustering, which is quantified through the Hurst exponent. To tie it back into our spot vol bite not too long ago, the Hurst exponent, if it's above zero point 0.5, it's trending. If it's below zero point 0.5, it's mean reverting. And if it's at zero point 0.5, it's a random walk. So instead of applying this on returns, we're applying this on volatility. Um, and what you find is the variance risk premium is positive with increased persistence in up vol. So does that make sense? When the volatility clusters to the upside, that's when you see increases of realized variance or realized vol, and the up vol or upside vol accounts for a larger proportion than the downside vol in the overall realized vol picture. So, and this coincides with contango.
Hmm.
So it's like you have higher contango or higher positive returns, higher realized variance, higher upvol persistence. And the same pattern plays out with BTC variance risk premium. Not
Might be,
it's
yeah.
not as definitive as ETH, but the picture comes into more focus post 2023.
No, exactly. Yeah, can you? So, if I'm just a variance risk premium, it seems that the BTC is a bit more like cluster on zero. But yeah, if you go back for 1 second to
Yes,
the ETH one, there is a lot of, yes, shifts and ebbs and flow, but it seems to be constantly on the upside. So this is, I mean, the sign is that realized is higher than implied, or how do you?
yes.
Okay,
It's the realized variance is higher than the implied variance.
this is uncommon, right, in most equity, and I mean, this is maybe I don't know if it's in commodities as well.
Yeah, yeah. Equity is negative most of the time. Most of the time, what's interesting is, and this is going back to natural gas, like natural gas compared to other variance risk premia is negative a lot of the time, or more severely negative. Yet it has the highest peaks. So when realized vol spikes or realized variance spikes, it really spikes.
I mean, natural gas, the Widowmaker trade. I don't know if you've
Yes.
been exposed. I think it was trading like on Tasty Trade, like they have a small, like small natural gas futures, but no, I got wrecked even at that small size.
Mm. Yes, very tough asset to trade.
Okay. But yeah, interesting. So I mean, you could
Yeah, it
probably,
bears noting, sorry, I should have originally said this with this slide. Positive returns like uh, symbolize contango in the context of perps. Negative returns signify backwardation.
yeah, and also the volatility that we are measuring, I guess, is the implied. It's also like not fully complete. Again, a lot of this is the Durbit or Uniswap. Uh,
This is Uniswap.
yeah, so this one has one side of the market missing in a way because you cannot buy optionality easily. And
Mm,
again, Panoptic, of course, but then certainly not in 2022, 2023. But yeah, I would say that the realized being higher probably tells you more about implied being too low as opposed to
yes,
realized being.
no, that's a solid point in that you could, yeah, there was no uh, ability to buy options on or reverse the trend within pools until recently.
Yeah, but yeah,
So that may have something to do with IV being depressed.
because yeah, definitely that's right. BTC a little bit more tame, but again, maybe a bit more mature as well in terms of market. But yeah, uh,
Yeah. But all this leads to some overarching patterns I found with ETH and BTC, which is that higher contango translates to a higher variance risk premium and a higher upside realized volatility persistence. All three of these coincide in terms of timing. But what's interesting is when you have higher backwardation, there's a negative variance risk premium, meaning that implied variance is higher than realized variance. And this also translates to a negative IV skew. Like the higher upside realized volatility accounts for a higher proportion of the realized variance, whereas the higher downside implied volatility accounts for a higher proportion of the implied variance. So there's a divergent um, uh, spot vol dynamic on the realized side versus the implied side. And what do I personally, and the factor that I think personally ties in, or I personally think ties into this, is the crypto native convenience yield, which I've touched on before. In traditional commodities markets, you have a convenience yield that dictates term structure. So going back to the title slide, right, it's all about emptied storage and filled storage. When you have filled storage, it's contango, emptied storage, it's backwardation. And really, what the convenience yield is about or signifies is it encompasses the added convenience of owning the physical underlying asset. Now, in traditional commodities, this is modeled as a call option, like being long a call option, because when you have a backwardated term structure, um, as I display on this slide, so futures being at a discount to spot, they have to converge at expiration, right? So the futures roll up. So it's almost like being a call option on the futures if you own the underlying spot. Whereas for a contango term structure where the spot trades at a discount to the futures, it's like owning a put option because the futures come crashing down at expiration. It has negative roll yield. Where it diverges completely in crypto is um, there's actually more benefit to owning the futures than the physical underlying due to leverage as well as we've seen it before in FTX and other cases. Uh, Exchanges shut down. You can't get a hold of your actual BTC or ETH in your wallet. So in this case, where the dynamic is totally flipped and there's more convenience to owning the or to trading in the future than the underlying, it's akin to selling a put option because there's a long-term contango and as well as you own the future, there's an added benefit to owning the future instead of the spot. So it's like an embedded put option almost in the implied volatility. So you have this realized FOMO on the way up, but it portends implied doom. And this has been found before in BTC to where you have like as the carry or the contango increases, the volatility skew decreases. So I think that's a really interesting differentiating factor. Does that make sense in terms of like there's a realized versus implied complete divergence?
And yeah, no, it's very interesting. So you say this is not necessarily something that you see often in other type of assets, and
I don't think so, just
okay,
because of the that added incentive to trade in futures versus the underlying in
yeah,
crypto.
and yeah, it makes sense. The FTX level hack may not happen as easily with more mature markets.
Or just your wallet getting hacked in general. There's added incentive to trade in the derivatives as opposed to the
I mean,
underlying.
yeah, even the perps, the perps, I mean, way of existing, I'd say, is also because of that. You trade with not necessarily your own thing.
Yeah, leverage is another reason how much leverage you get in the perps market.
Yeah, very cool.
So to tie it all in together, the key takeaways as I've gone throughout the presentation, it's an up the stairs, down the elevator dynamic. So it's that with increasing contango, it's complemented by elevated underlying price crash risk. So you see a realized variance asymmetry to the upside, implied variance asymmetry to the downside. Um, and this is also backed up by extreme contango, is accompanied by increased upside realized volatility persistence. Backwardation is accompanied by downside volatility persistence, um, realized volatility persistence. But as I highlighted before, when it's in backwardation, the variance risk premium often turns negative or severe backwardation. So realized volatility doesn't, or realized variance doesn't account for a lot. Implied variance does, but it's to the downside. So it's all about taking these relative proportions with spot vol dynamics. And in this case, the upside accounts for far more in realized variance than the downside, and vice versa when looking at implied. So it's both the ETC and BTC variance risk premia are dictated by upside realized variance, and those coincide with the contango and realized volatility, upside realized volatility persistence again. So this is very multifaceted. Um, I expect our viewers, like, it'll take a second to digest all of this because it's really unifying three fronts: volatility clustering, the variance risk premia, and futures term structure.
and and then maybe also for those that may not be aware about like the backwardation or contango, when you have a perp, this is like the sign of the funding rate, if you want.
Yes,
So you could think of that backwardation being your negative funding rate
negative funding rate, exactly.
when you're
And
short, and then it's contango, you're long, you're positive when you're short, or yeah.
yeah, yeah.
So the
Positive funding rate in contango, negative funding rate in
which,
backwardation.
and then I don't know if we've and that could be also another topic, but yeah, this is kind of contracting this multi-month almost expiry from futures, traditional futures, to like hour by hour, so you probably have a lot more interesting dynamics. But if
Yeah,
you're
exactly. Like going back to this at expiration, the roll yield, that doesn't exist within the perp world because there isn't an expiration.
so,
So
but
the
you have
funding rate, oh, go ahead.
the carry trade, I guess. As you said, you have a call option. If it's flipped, you have kind of this built-in funding rate on that perp if it's in kind of again backwardation mode. Uh, if you're depending on how you structure this, but yeah, I mean that's right. There might be interesting parallels between the instantaneous funding rate that you get if you are a carry trade on perps and then the risk profile that you're getting because of that negative funding rate.
Yeah, and also just to tie it into another previous bite or a few previous bites, like the convenience yield being unique to crypto that I've described is one of the gamma traps that I previously outlined, where um like as the carry rises or contango rises, put option values go up as the skew decreases. So so you see this self-perpetuating need to sell into downturns, right? As if it's an embedded short put option, at least on the implied side. And we've seen this bear out in the volatility risk premium where the put wings are higher than the call wings. So this kind of unifies a lot of prior concepts. It's the first time I think in panoptic research, though, that we've touched upon futures term structure and those dynamics. So it's all about trying to quantify it and disaggregate it into these various components.
And again, we do have a analogous quantity, which is the funding rate for perp. And
Yes,
when you create a synthetic perp, again, the way I think of about Uniswap and Panoptic is that you're adding liquidity or removing it. But if you create a synthetic long perp, you're buying a call and selling a put. So you're effectively removing liquidity from the call side and putting it in the put side. And
yes.
that is where you have this liquidity ends in the same bin if you want. Same exact structure as before, but
Mhm.
you just shift. Do you make money if it goes up or down? And call buyers would be now paying a tiny bit more, and put sellers will be get paid a little bit less. So this is also kind of indicative of the skew a little bit if you have the this being done at a higher scale. So this is also very again we'll put a little bit back to real data, but yeah, at the end of the day, what we're seeing, even what we're seeing now with Panoptic, is that there's a lot of call skew. People buy calls, so you would have probably a negative funding rate from going long in a weird way on Panoptic because of that call skew. So contango backwardation is what we
Yeah, and that, no, that bears noting because I'm not sure if the convenience yield still applies, but whether it's off chain or on chain, but I don't know if these exact dynamics would apply um, off chain just due to the maturation process that you were outlining,
yeah.
like with those funding rates and not being able to long optionality until recently.
Yeah, exactly. And again, we yeah, maybe subject of another research by, but again, within even with Rosalie and the intern account, we've had some positive rate longs, long perps. They were negative for a while back. So this is also something we can also track. It does change over time too. So very, very cool. But yeah, I
Yeah.
think this is
So,
yes.
oh, sorry, I was going to say just something to keep in mind, and this is kind of a unique perspective on it. Like variance risk premium, futures term structure, and vol clustering. Um, they're all intertwined, but I don't think you'll find these concepts borne out in the literature. Like there might be one paired with the other, like futures term structure and variance risk premium or variance risk premium volatility clustering, but it's the binding of all three that I think is unique here in terms of being a potential trading
We're
indicator.
writing the textbooks as we speak.
Yeah.
Definitely a brand new world. Very, very cool. This was again, the variance risk premium is something that is very, very important. Now we have Popper
Yeah, and
will do
just
this.
to foreshadow potential future research, another way to look at the variance risk premium is the payoff of a variance swap. So it's just the realized variance minus the implied variance times some notional amount. And in the option centric world, the reason you focus on the variance risk premium versus like the volatility risk premium, volatility risk premium is like implied vol versus realized vol at a certain strike, whereas the variance subsumes all of the strikes, the
Yeah,
entire options ladder. Um, so uh, some people frame it the opposite way in terms of the equation. Some people have an implied variance minus realized variance, but because of that variance swap payoff, I like to keep it realized minus implied as opposed to the other way
yeah,
around.
and I think it's also the yeah, and then what is a little bit more concrete also in terms of what we have in say on panoptic is the theta, how much you get, and this is scaled with variance, like linear invariance. If you were to get a square root or the real implied volatility as opposed to variance, it's making them a little bit more complex. But now, yeah, this is very very cool. All right, yeah, we'll probably revisit this. This is a very integral topic to any options traders. But yeah, again, we'll probably look at opportunities. As I said, there's a lot of interesting opportunities because the markets are so new and maybe immature on Panoptic. There's still this alpha that can be edged out for some of
Mm.
those. But yeah,
Yeah, absolutely.
all right. I think that's it. So we'll do the outro music. This was great. Great.
Sorry, you broke up there. I couldn't
Oh,
hear
okay.
you.
So again, a lot of what we do is these research now get transformed to a research bite. Maybe this is going to be something also you can see out of the main account. But yeah,
Yes,
all right.
pretty soon.
Pretty soon, stay tuned. We'll see you. I'll see you maybe in a couple of weeks, Nathan. But otherwise, we have the Stop Losing, Start Trading show tomorrow. Also, Friday, we have the best and worst trades of the week. But yeah, in the meantime, take care and see you next time.